had mentioned in our previous TITM how the pause in the rate hike by the Federal Reserve was more of a hawkish pause and that the Fed could keep the possibility of a rate hike open in the next meeting in July. As anticipated, yesterday the Federal Reserve resumed its rate hike campaign, raising the target rate by 25 basis points. Now, this decision brings the overnight federal funds rate to a range of 5.25% to 5.5%, the highest level in 22 years. The move also comes as the Fed continues its efforts to combat rising prices, even though headline inflation is starting to ease in the US. Inflation has been a concern for the US economy, with high rates experienced for several months. However, the latest data shows a significant improvement, with inflation now at 3%, down from 40-year high of 9.1%. This marks the 12th consecutive month of slowing price increases and closer to the Fed's target of 2%. Despite this, the Federal Reserve Chair emphasized that they are being cautious and not making decisions based solely on one data point. Now, to be fair, core inflation, excluding food and energy, has also been slower to come down in the US. Fed Chair also said that other economic indicators reflect a US economy which is still running too hot, that has weighed more heavily in the decision to enact another rate hike. The US economy has demonstrated resilience with stable wage growth, low unemployment, and strong consumer spending. Looking ahead, Fed will take a meeting-by-meeting approach to determine whether further rate increases are necessary. He hinted at the possibility of another rate hike in September, but also stated that they might choose to keep rates steady at that time. And what particularly caught my attention was the Fed's chair's comment that the Fed is no longer predicting a recession in 2023. However, they are still anticipating a noticeable slowdown in growth later this year. The Fed's current aim is to engineer a soft landing, meaning that they want to curb inflation while also avoiding a sharp economic downturn. Now, as an investor, the crucial question to consider is, will the US be successful in engineering a soft landing for the US economy? Days after the successful demerger of the financial services arm from its parent company, Jio Financial Services Limited and BlackRock, which is the world's largest asset manager, have joined hands to establish an asset management company in the country. Now, the two companies will own a 50% stake each in the newly formed entity called Jio BlackRock, with an initial investment of $300 million. Now, BlackRock, which handles 7% of all global financial assets, will re-enter the Indian asset management industry after a gap of 5 years in 2018, when it previously was associated with DSP Mutual Fund. Now, this partnership is a significant development for the Indian asset management industry. This joint venture is expected to help bring new products and services to Indian investors and hopefully make asset management more accessible to a wide range of people and deepen the Indian market. Now, Reliance especially has been known to enter businesses and quickly grab market share, disrupting the sector with its competitive offerings. Now, the big question is, can Jio BlackRock make a mark in the Indian asset management space, which has already been dominated by several prominent players? With that, this is me, Merlin Susanna, signing off. Take care and stay invested.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.
Equity investments are subject to market risk. Read all investment-related documents carefully. Visit www.researchandranking.com